Evening members, may I now request Vijay sir to occupy the dais. May I now request the delegates to occupy the front round rows, please. Round tables you can occupy. Since it's a very limited audience, it will be more interactive if you occupy the front rows. I once again welcome you all to the CPE State Circle meeting on international tax provisions, thin capitalization and secondary adjustment in the context of amendments to Form 3CD. The session speaker is CR Vijay. Before we proceed to the technical session, let us rise for ICA mode. Thank you, members. Since it's a tax audit season, we couldn't attract much of the members since they are busy in their tax audit work, it seems. I'm happy to introduce the speaker. Vijay, a chartered accountant by profession, is a manager in a global transfer pricing services in a leading firm. With close to 6 years of experience, Vijay has worked on engagements pertaining to transfer pricing, planning and structuring, advanced pricing agreements, preparing transfer pricing studies, handling audits and litigation. Vijay has experience on working in diverse projects across diverse industry sectors and has handled multiple complex engagements. He also has experience on working on BEPS projects and aligning documentation with Indian transfer pricing regulations and OECD guidelines. Vijay also contributes to articles at various forums on transfer pricing issues. Over to the speaker.
Very good evening to everybody. Thanks to SIRC for the opportunity, and I'm as excited as you all to know how much I would learn from this session by interacting with you people and also sharing a little bit of knowledge that I possess on this topic. So the topic for today is international tax provisions, specifically dealing with thin capitalization and secondary adjustments in the context of amendments to Form 3CD. So when I was actually thinking, what do I have to talk about, two particular clauses which have been introduced in the Form 3CD, and why are these two topics creating such impact in the fraternity, both the members and the companies. And that's when I thought it's important for me to cover the concept of what is thin capitalization and what is secondary adjustment. And also then, after I explain the tax audit provisions, put open a discussion to probably understand myself and to help you understand certain questions that has left unanswered by everybody. So we start with thin capitalization first. So generally when there is a client request who comes and says, I want to have ideas on how do I repatriate money, and all of us will have opinions and we will have structuring options, and the first thing that we come up and say is probably evaluate a buyback of shares or maybe royalty, FTS. And all these mechanisms have been plugged over a period of time. And Royalty, FTS are again subject to withholding taxes. It affects the operating margins of the company, subject to transfer pricing separately, and buyback of shares are again now being taxed. So one thing that probably is not given as much attention, or maybe not given as much weightage as it ought to have been, is the debt structuring. And debt assets gives a double benefit that not many of us realize because of the cost that the company thinks it will incur by availing this debt. But what eventually happens is that this debt will give a benefit both for the company in India and as well as for the group outside. I will explain how that happens. And this particular issue was what was dealt with in particular by the BEPS Committee on the Base Erosion Action Plan, and a specific action plan has been issued only on this particular topic of thin capitalization and limiting interest deductions. So what is thin capitalization and why is this important? So every company requires funding for its operations, and mostly it is being funded by equity or debt, the two straightforward options for funding. And within equity, you only take equity shares. Preference partakes the character of part equity and part debt. And within debt, you always have multiple options: CCDs, ECBs, and different types of loans that are being given in the market today. But what is thin capitalization and why is that important? So the difference is, when an entity is going to be funded majorly by equity, then we call that entity a thickly capitalized entity. And an entity that is being funded mainly by debt, that becomes a thinly capitalized entity. Now, every group has its own policy that it would devise on how it would want to fund its subsidiary companies. So this particular topic is majorly towards MNCs or companies which have associated transactions. So I will probably give it in that context of how the transactions happen between multinational companies within India and outside India. So when the issue comes of how do you fund your subsidiary company, every group as such will have a policy of equity, debt, depending on how it is going to optimize the available funds of the company, of the group, vis-a-vis how it is going to give a tax benefit for the company in India as well as outside. So in that case, how do they decide whether to go for a debt or an equity? Because equity, a company can't be pumping in equity beyond a point if it is not doing really well. Because the more and more I pump equity, and if it is not giving me returns, tomorrow when that equity has to be taken back, then the value of that equity is much lesser. So how does that group company earn its returns on the money that it invests? Then it goes for the debt option. And that option, the Indian company gets a deduction for the interest. That gives a tax benefit for the Indian company, and the foreign company is able to earn its return on the money that it invests in the foreign company. Now, why is there a requirement to curb this? Or what is this whole furor about thin capitalization and limiting interest deductions, and why is it necessary? I think it's important we go through this particular illustration. It's a pretty straightforward example. I've kept it very simple and not complicated it as much as possible. So let's take an example of a company that has only equity and there is no debt here. So its subsidiary company has a sales of 100, a COGS of 75 and depreciation of 10. So an effective PBT of say 15 rupees for illustration purposes, and then remember there is no debt funding for this company. Then after the PBT level, what are the taxes that the company is going to incur? It is going to pay 30% on 15. For computation purposes, I've not taken surcharge and cess and kept it simple. So 30% of 15 is what the company will pay as corporate tax in India. And after that, the profit after tax, which is 10.5, if the company has to repatriate this money back to the parent company, then it is subject to dividend distribution tax. So effectively, the company is going to pay 30% on its profit before taxes and 17.65% DDT on the profit after tax. And this is the amount of money that the company has to pay to the government to be able to repatriate the profit that it has earned back to its parent company. And this dividend will be taxed in the other country, may not be taxed in the other country depending on the respective country's regulations. But what happens if I have to slightly tweak this model and find other ways of repatriating money back to my parent company? Keeping FEMA regulations aside, whether a company would be able to borrow money or not, assuming that they are able to borrow money and allow under the FEMA automatic route, and they have a borrowing of say 50, which has been availed from its parent company for the purpose of thin capitalization regulations, then I pay an interest of 5 rupees on such 50 at say 10%. Now from a transfer pricing perspective, I will have to test this particular transaction of interest whether it is at arm's length or not. And if I am borrowing this money in INR, then I might very much be able to justify even a say 6% or 7% from a transfer pricing perspective. Because if I have to borrow this money from a local bank, I would end up paying as much as 9-10%. So then I have this transaction which is being separately tested for arm's length. And interest as such is a financial transaction. So then what happens, this particular money which I am paying to my parent company will not impact my operating profit margin. So even if I have n number of international transactions, say purchase, I have royalty, I may have any other transaction, my operating profit will still remain 15 because this interest component is not going to be factored for my operating margin computation. So none of my international transactions are going to be affected by this. The operating margin remains the same. I will still be at arm's length from all these transactions, and the interest also I will be benchmarking it separately. So now what happens, my PBT falls down to 10 and I have a 30% tax on the 10 rupees. And after tax I have a repatriation. So effectively I have repatriated 5 rupees from India to my parent company, getting a 30% deduction in India. Now the obvious question is, this money is anyway going to be taxed in the parent company's hands? The answer is yes. I am not saying no. But what would be the arbitrage that the company gets by virtue of making this payment will be higher than the amount of income tax that the company is going to pay by earning this interest. And there is another particular concept called hybrid mismatch. A separate action point has been issued on hybrid mismatches, where there is a possibility that an instrument of debt will be treated as equity in another country by virtue of their regulations. Say Netherlands, for example, if it's a holding company in Netherlands and a subsidiary in India, debt and interest income for the Netherlands company will be treated as equity in their jurisdiction and they will not be taxed on this money. So then I have repatriated 5 rupees from India to the other country without suffering any taxes in India and not having to suffer any taxes in the recipient country as well. So then what happens, and how do we curb this? Because there should be a position where I can't be repatriating such money indefinitely and earning such arbitrage on the payments. So how do we put, or what are the benchmark that we apply to stop this was what was the particular topic of deliberation for the PEPs. So what are the particular guidances that the OECD has given when it comes to the base erosion and profit shifting action plan number 4? So the main concern for the OECD was, how do you stop this debt instrument from being a mechanism for profit repatriation? And every company or every group will have to have a limit of how much it can fund its subsidiary, how much debt can a company take vis-a-vis how much equity can a company take, because once at some stage if the company is going to be liquidated and if I have to repatriate the money, debt gets priority, and the amount of, if it's going to be thinly calculated, then so much interest deductions and the priority of paying on the liabilities will go to the debtors and the equity will be eroded for the parent company. So in that context, the OECD came up with certain suggestions on what is the regulation that specific countries can adopt to curb such mechanisms where the debt will be used as a necessity where funding will be required. Say for example, certain companies may get a beneficial rate by virtue of using their parent company's influence on banks. Yes, that is permitted because that is why you operate as an MNC and you would obviously want to get benefit of the brand that the parent company has developed. But within that framework, this shouldn't be used as a tax evasion mechanism, and that is where the BEPS action point was introduced. And the suggestion that came out of the BEPS action plan was, let us bring a mechanism to limit the quantum of interest that each company will claim as a deduction. That is one of the aspects of the BEPS action point which has been implemented in India. But the BEPS also talks about what is the optimum debt to equity ratio, based on the research data that they have of all the companies outside India, within India, across the world. And they suggested that a debt equity ratio of 2:1 is the optimum working possibility for many companies in the world. The 2:1 ratio was based on numerics of multiple companies having furnished their data and a lot of simulation analysis which they had arrived at. But a 2:1 perspective is the optimum debt equity ratio where there will be not much of a tax erosion. And the OECD also came up with 2 suggestions on how do you limit the interest that a company can claim a deduction for, and one is a fixed ratio rule and the other is a group ratio rule. So how significantly different is this, or what is a fixed ratio rule, what is a group ratio rule? It's very simple. Fixed rule ratio is nothing but there will be a threshold defined and the quantum of interest that a company can claim will be restricted to that particular threshold. As simple as that. No complications. I have X number which the government will prescribe is the maximum amount of deduction that you can claim, and I will not be able to claim anything more than that. Now, what are the downsides of this? My group could be in a much more favorable position to take down this 30%, or that has been prescribed in India, or any other percentage that the countries may provide for. Or maybe this particular percentage is way higher or way lesser than what will be the effective interest cost or earnings of the particular group company across the world. So how do you leverage, or how do you kind of bring a balance between what the group's actual position is? Because naturally the group may not be suffering such excess taxes or maybe a tax evasion in place at all. Then you have the concept of a group ratio rule. Group ratio rule is more practical, I would say, because you have a group's interest by EBITDA, the earnings, which will be the basic threshold, and then the entity's ratio, the threshold of interest to EBITDA, shall not be more than what the group can earn. So it's kind of benchmarking your allowance based on what is the capacity of the group as a whole. So that kind of brings a balance between how much a company will claim as the deduction, how much a company will not. So if X company of an entire group is going to claim significantly high amount of interest, which is way more than what the group as such is going to incur as the debt cost, then that creates an imbalance, and that is causing an erosion in one particular country where you take a debt and then it's being funded in another country and they are going to take the interest benefits. And how does the OECD arrive at this number? The OECD prescribed a range of 10% to 30% range for the fixed ratio. The group ratio doesn't have a number because it will vary for every MNC group. But for the fixed ratio, the OECD came up with a range of 10 to 30%. Now, how was this? It's a very interesting analysis which the OECD has done, and I will just take a minute to explain that. So based on the data that OECD has from the company as well as the tax administration, they ran a simulation analysis. And they said, if I am going to cap the interest deductions at 10%, then how many companies, based on their current numbers, will be able to claim a deduction of the total amount of interest which they are actually incurring now? Then I expand that threshold limit to 20. Now how many companies are able to claim a deduction? I increase it to 30, 40, 50. They ran the simulation analysis at different percentages and then arrived at this range of 10 to 30, where they said at 10%, 62% of the companies across the world will still be able to take a deduction of the entire amount of interest that they are paying in their respective countries. At 20%, that number goes up to 78, and at 30%, it goes up to 87. So then we have removed the outlier. Beyond 87, then there is no purpose of bringing in a regulation. Less than 60, we are not trying to oppress MNCs here for their way of business operation. So we have a range of 10% to 30%, within which close to 60 to 87% of the group companies would still be able to continue or conduct their business in a way without having to significantly alter their businesses, but at the same time there is no significant arbitrage tax evasion which happens. This action point was introduced in 2015 and has been in deliberation for a lot of years, and as expected or inevitably this had to come into the Indian regulations, and Finance Act 2017 brought this amendment into the Indian Act, introducing a section called 94B, which is nothing but limiting interest on interest claim that a company can claim in its tax return. In the strict parlance, this is not fully a thin capitalization regulation, I would say, for the reason that the regulation doesn't prescribe how much debt, how much equity I should have. It rather only restricts my interest that I can claim and still gives me a benefit of having to carry forward for a subsequent period of years. So it's kind of a section that gives me a deferral of my interest based on how much taxes or how much profit that I earn in India. But it is a fallout of the thin capitalization regulations that has been introduced in India. So first things, who is this section applicable to? All Indian companies and permanent establishments of a foreign company. And it is applicable where an entity avails of borrowing from a non-resident entity. Let me put it in double quotes. This particular term is very important for all subsequent discussions. But when it avails of borrowing from a non-resident entity, and such entity is an associated enterprise. So there are two conditions here. The first condition is I should avail this borrowing from a non-resident entity, and second, that entity should be my associated enterprise. Now the term associated enterprise shall get its definition from section 92A for transfer pricing, where an entity directly, indirectly controls, has control in the control capital or management, or directly or indirectly has plays a role in the control capital and management. In such cases, where there is a borrowing from a non-resident and there is a borrowing from an entity which is an associated enterprise, and the total amount of interest that the company is going to pay in that particular year exceeds 1 crore rupees. The second threshold comes in terms of the amount where it is 1 crore rupees. Then this section shall apply. So first condition, borrowing from a non-resident. Second condition, the company should be an associated enterprise. Third condition, I should have paid an amount in excess of 1 crore. The term here is interest or expenditure of similar nature. So what is expenditure of similar nature? I will deal with that. So probably I will take you to the act, and that would give you a better perspective of how to interpret the section. It says, notwithstanding anything contained in this act where an Indian company or a permanent establishment or a foreign company in India, being the borrower, incurs expenditure by way of interest or similar nature. And this is also important because the quantification will depend on how much, or what will depend on what kind of expenditure that the company incurs, and exceeding 1 crore rupees, which is deductible in computing income chargeable under the heads profit gained from business in respect of any debt issued by a non-resident being an associated enterprise of such borrower. The interest shall not be deductible to the extent it arises from excess interest. So three conditions: being a non-resident, associated enterprise, and amount exceeding 1 crore rupees. If I have excess interest, then I will not be able to claim a deduction. There's a slight modification or inclusion to the list of borrowings which will be covered, which says if I have a borrowing which is not from an associated enterprise, but my associated enterprise has given a guarantee for it, or it has deposited a matching amount in the bank against the loan which the Indian company has taken, then such debt shall be deemed to have been issued by the associated enterprise. So today I don't have to borrow directly from my parent company, but if I'm going to borrow from a bank, and in most cases in MNCs you would find that the subsidiary company's borrowings are being guaranteed by the parent company, then such borrowings will also be deemed to have been issued by the associated enterprise for the purpose of section 94B. And what is excess interest? It's a very straightforward computation from a bare reading of the section, but there will be a lot of complications which I will explain later. It says excess interest is nothing but the total interest paid in excess of 30% of the earnings before interest, taxes and depreciation. So the total interest that the company is going to pay in India which is higher than 30% of the EBITDA of the company, that amount will be termed as excess interest. Now this excess interest on one hand and the actual amount paid to the associated enterprise on the other hand, whichever is lesser, that amount is going to be disallowed. Is it clear? Or so I have the interest paid reduced by 30% of my EBITDA, which is being fixed as a threshold. The excess amount or the actual amount that I pay to my parent company or associated enterprise from whom I am borrowing this money, that amount, whichever is lesser, will be the amount that will be disallowed for thin capitalization purposes under 94B. There is a particular exclusion that has been given here. Banking companies and insurance companies, for obvious reasons that they always deal with debts, and these two companies have been excluded from the purview of section 94B, and this will be only applicable to all other companies. Guarantee need not be written. The section also says implicit guarantee. So I don't really have to have a particular tripartite agreement between my parent company, bank, and the Indian company. I don't need to have a letter of guarantee or a formal communication given by the bank to my parent company for having been guaranteed. Even an implicit guarantee will be covered for the purpose of section 94B. And the section also gives me a benefit of carry forward for 8 years. So what happens if I incur interest expenditure in excess of what is being allowed as per the regulations? I will be able to carry forward for a period of 8 years and set it off in the year where I have interest expenditure less than 30% of the EBITDA. What is debt? So the section only says any debt received. So what is debt? It goes with the straightforward definition: loan, financial instrument, leases, derivatives. Everything would fall within the context of debt instruments. And what can be included in interest or similar consideration? It will be service fees, your interest charges, lease payments in case of a financing lease. Mind you, there's a difference between operating lease and finance lease. It is only finance lease which will be considered as a debt, and the operating lease will not be considered. Now here, the Indian Act doesn't define what is interest or similar nature or what is debt. So reference is generally drawn from the OECD, which has a list of what will be the kind of expenditure which will be considered as similar nature, and it says imputed interest, or if it is a profit participating loan, then the amount of profit which is deemed to be interest, that is also considered as interest or similar nature. Interest which is being capitalized will also be considered as interest or similar nature, or the guarantee fees or arrangement fees which the company pays will all be considered as interest or similar nature. The OECD also prescribes certain exclusions, and one of the obvious questions that comes in case of a foreign currency borrowing is my hedge cost going to be considered as interest cost when I'm paying it to the bank? And though the Indian Act doesn't clearly define what it is, the OECD says hedge cost need not be considered. The hedge cost in any case goes to the bank and doesn't go to the associated enterprise, so my hedge cost is not going to be considered as a finance cost. In the hypothetical situation of this of a guaranteed loan being considered as a deemed loan given by the enterprise, again it is only the interest component which has to be considered, and the hedge cost will not be considered as interest. Neither will the forex fluctuations be. So it is only those expenditures which generally partake the character of an interest will be considered for this purpose. What is guarantee is again not been defined in the Act, and it's all subject to the interpretations, because you have different types of guarantee: you have performance guarantee, finance guarantee, you have letter of intent, letter of comfort. All these instruments being brought in by the banks as different mechanisms for as a collateral security for the borrowing. And since the section only says implicit guarantee, then I would generally say everything will be covered as part of a guarantee. Even a letter of comfort or even a letter of undertaking, everything would fall within the characterization of implicit guarantee, because that is one of the important documents for that borrowing being given to the subsidiary company. Broadly, like I said, section 94B has been introduced in line with what are the guidances of the action point, but India as always has been a relatively aggressive tax jurisdiction, and there are certain points favorable which are considered, certain which are not considered. Like for example, India has not taken into consideration the group ratio. There is something called an equity escape in the BEPS regulations, which say if my total equity to asset of the Indian company is less than the equity to asset of the group, then such companies will escape this thin capitalization regulation as per the action point. But once again, India does not want to give any loopholes for companies finding out ways in which this regulation will not apply. So those regulations have not been brought in 94B. Approach remains broadly similar with the fixed ratio rule, just that OECD prescribes a range. India has taken a fixed number of 30. Threshold, the OECD only recommends, it doesn't prescribe, and India has a threshold limit of 1 crore. Carry forward has been discussed in the OECD guidelines. Again, it doesn't say whether to give carry forward, whether not to give carry forward. India has been liberal enough to say, yes, you can carry forward this amount of interest for a period of 8 years from the year of disallowance. Deemed interest from AE, it has not been specifically dealt with, but it's only a discussion around the guarantee fee, and that has been included in the Indian regulations. And exclusion remains consistent between the BEPS and Indian regulations. The banking and insurance companies will not be subject to such regulations. So broadly, India has followed the footsteps of the OECD, impending because India is part of the G20 group of companies which went hand in hand in preparing these action points along with the OECD, and it is only natural that India someday would be implementing most of these action points which would be relevant from an Indian tax and business perspective. Any questions so far? Anybody to be addressed? Great. So what does the tax audit report? Yeah.
Regarding that capitalization, how does it work in case of capitalization? Where is the question of
It will not be. So the capitalized interest concept comes in the OECD. India has not included. And if you read the section of 94B, it clearly says interest which is deductible in PGBP. So in India, it will naturally not apply, because once I have a section which is deductible in my profits PGBP, then I will generally not have the situation here. So there, because there was this concept of equity to total assets, a ratio which they arrived at, or they had a group ratio, for the purpose of arriving at that ratio, you take these interest costs, but in India it will not be applicable.
So in the case, in case of capitalization, there is no disallowance.
There will not be any disallowance because it is not deducted in your profit. The main condition there is you should be claiming a deduction of that expenditure in your taxable income computation.
In case of this construction companies, percentage of completion method, it comes indirectly to your P&L, right?
Sorry, and in case of?
In case of construction companies, percentage of completion method we follow, based on that only we recognize the expenditure, right? So this interest cost will be forming part of that inventory cost.
Correct.
So based on, from that only it will come to your P&L.
So much component that comes to your P&L will have to be considered, irrespective of what nature you characterize that amount as. Whether you will show it as inventory, probably it will add to your cost of the asset. But to that extent, you will still have to consider, because for the purpose of this section, it is only interest. The business that you do and the method of accounting that you adopt, you add it to your inventory cost. But for the purpose of taxable income, it will still be interest.
Just one clarification. If suppose say 10 million is debited in the P&L, and that is going to be separately discussed in the TP assessments, whatever it is, you have to arm's length price for whether that's the interest rate is right. Suppose post this thin capitalization, I'm only allowed to deduct say only 4 million instead of 10 million. Still my arm's length calculation will have to be done for the 10 million, and still I'll be eligible for deduction only for 4 million.
Precisely, yes, because two separate sections, and 94B starts saying notwithstanding anything else in the other provisions of the Act. You will have a reverse situation, because if you have a TP disallowance alternatively, then you need not consider this for 94B purposes, because you are not claiming a deduction there. So let's say, for example, I have an interest of 10 million, and I am voluntarily making a disallowance in my return of income, saying it is not at arm's length, and I am reducing a portion of it and offering only so much, then I am naturally adding it back to my income. Then you need not consider that for 94B purposes, but the reverse is not possible. You have a disallowance here, you will still be subject to disallowance in 92. Okay, so before I come to the tax audit clauses, I just thought I'll take a quick run into what different illustrations of what would be the possible situations in which thin capitalization would apply. The first two examples are pretty straightforward, where I have borrowing from a foreign AE. The AE provides debt to the Indian company, I pay interest so long as this value exceeds 1 crore, thin capitalization would apply. And second situation is where the AE guarantees my borrowing to the lender and the Indian company borrows. It will still be applicable, but there are slight modifications to this which I will discuss in the subsequent slides. So this is the situation where I have a borrowing. Which part is going to be covered under thin capitalization? I have two borrowings. I have a borrowing from an Indian bank. I have a borrowing from the Indian branch of a foreign bank. Whether section 94B will be applicable in both the cases, or is it going to be applicable in only either of the cases?
It says the non-resident is one of the criteria for...
Precisely. So my borrowing from an Indian bank will not be considered. It is only the borrowing from the Indian branch of a foreign bank, provided this amount is going to be guaranteed. Because as of now, I am borrowing this only from the bank, and if there is no guarantee, then there is no thin capitalization regulations. Only if this amount is going to be guaranteed by my parent company, then the second leg of the transaction falls within the purview of 94B1, and the first half doesn't.
So if there is a guarantee by the parent company to the Indian bank in India, then it will not apply.
It will still not apply because my lender is not a non-resident.
That can happen is a different question, but
it makes a very big impact, because in most of the cases you will find that the borrowing will happen only in Indian banks. So long as the lender is not a non-resident, section 94B will not apply. So guarantee by the parent company. So this is the example where the bank is going to be in the AE's jurisdiction, then thin capitalization regulations will apply. And the two alternatives here, the exact discussion what we just had. The Indian company is going to borrow from SBI India or HSBC India branch. Now the second situation, it is a non-resident entity in India, because the branch still is going to be taxed as a non-resident. SBI India will be a resident entity. So though I have borrowings from a bank in both the situations, and both the loans are guaranteed by my parent company, 94B will apply only in situation 2, and it will not apply in situation, for the clear definition that it has to be from a non-resident. The main reason why this has been brought in is that there is no base erosion as far as it comes to borrowing within India. There is no arbitrage, because both the companies are residents of India and the tax laws remain the same. So it is only those particular instances where there is a borrowing from a country outside India. Now interestingly, there was a writ filed in the Madras High Court by Siemens Gamesa, which challenges the constitutional validity of 94B, saying this is a section which is prejudicial to the interests of the company, mainly because of the situation that interest paid from a resident lender. This came before the clarification came that this will not be applicable. So once the section was introduced and there was a notice issued to Gamesa that this particular loan is being guaranteed by a parent company, and therefore section 94B will be applicable, Gamesa went on a writ petition saying there is no possibility of a base erosion where the loan taken from a resident lender with the guarantee of an associated enterprise will not constitute or will not fall within the purview. And more so that this creates a disparity, that merely because I am availing the benefit that I can get from my parent company, you are putting it to a dispute that if I had availed a borrowing from, say, a resident entity or from a normal bank, then this whole section would not be applicable to me. Citing this disparity, generally there could be other situations. Say for example, this company is a company that is into wind turbines and erection of wind turbines. So they have situations where most of their projects will have to be subject to a performance guarantee to the customer. And in that case, most of these performance guarantees are through the group. The group as such will have a consortium with the banks, and they provide performance guarantee to all such subsidiaries across the world. So they challenged the introduction of this section, saying this shouldn't be constitutionally valid because of the disparity that it creates. And even though it is being guaranteed, unless and until there is a demonstration of a base erosion, because still there is no relationship, you cannot introduce this section. This writ has been admitted as on date, but it's not been adjudicated. So as it stands today, 94B will be valid and applicable for assessment year 18-19 that we will be reporting for. So now let's come to the tax audit. Form 3CD was amended and they introduced two new clauses from a transfer pricing perspective, 30A dealing with secondary adjustments and 30B dealing with thin capitalization regulations. The question looks pretty straightforward. Don't be fooled by it. There are a lot of discussion points that will come up as I take this session further. But the first question that you have to deal with is whether the assessee has incurred expenditure during the previous year by way of interest or of similar nature exceeding 1 crore rupees as referred to in subsection 1 of 94B. So I will probably bifurcate this into three parts. Whether the assessee has incurred expenditure during the previous year by way of interest or similar nature, first part, exceeding 1 crore rupees, second part, as referred to in subsection 1 of 94B. So now if I have to go back to 94B, I have three conditions there. Non-resident, associated enterprise, 1 crore rupees. 1 crore is a condition that is separately given here. So subsection 1 will now give me two conditions that are remaining. It has to be a non-resident, it has to be an associated enterprise. If the company has entered into such a transaction, you give the answer as a yes. If it is a yes, then you have to answer the subsequent questions. What is the amount in INR of such expenditure incurred? Again, interest or similar nature. No definition in the Act. We fall back to what is the general understanding from the OECD regulations. Second point, clause 30B2, B sub B2 will be what is the EBITDA of the company, earnings before interest, taxes and depreciation. Straightforward calculation, no adjustments to be made, you do it from the books of accounts. PBT, add back interest, add back depreciation. Third point is amount of expenditure by way of interest of similar nature as per 1 above, which exceeds 30% of the EBITDA of 2 above. Clear? Not actually. Details of interest brought forward as per subsection 4 of 94B. So 94B4 is nothing but the section which says you can carry forward this interest for a period of 8 years. So amount brought forward for the purpose of assessment year 18-19, this amount is going to be 0 because this is the first year in which this section is introduced. Subsequent years, you will have, if the company has a carry forward interest, then you can claim this amount as interest. And mind you, the tax audit report, the online schema allows you to add multiple rows. So probably 3 years down the lane, 4 years down the lane, you might have carry forward interest for different years. The schema could probably permit you to do it year-wise and not having to accumulate it as a single number. Like how you do it in your income tax return year-wise, you would still be able to do it in the Form 3CD as well. And the last point is details of interest expenditure carried forward, which is the amount in excess of 30% of the EBITDA. It seems to be pretty much straightforward if I have to do this, but there are certain guidelines which have been given by the ICI when they introduced the implementation guide, probably to throw light into how do you answer each of these questions, or what are the different things that you have to take into consideration by the time you fill this report. First thing is, in the limit of 1 crore, only interest and expenditure which are deductible under PGBP should be considered. This is again from the Act because it says claimed deduction under profits and gains from business or profession. So first condition, if there is a disallowance under any section, 40A1 or 92C, any of this amount will not be considered for the purpose of computing 1 crore rupees. Second, what is the amount which has to be disclosed in point 1? Now, this is something that will be the point of dispute because the section says, I will once again probably jump down to the Act and explain what is the definition of excess interest under 94B2, if I can. So 94B2 for the purpose of subsection 1 is it visible for everybody or? Yes. It's fine, not visible. Thank you. Okay, I'll read it out for everybody's reference. It says, for the purpose of subsection 1, excess interest shall mean an amount of total interest paid or payable in excess of 30% of earnings before interest, taxes, depreciation and amortization of the borrower in the previous year, or interest paid or payable to the associated enterprise, whichever is less. So the difference here is there is a reference to total interest in the first option. There is a second amount which is given as interest paid or payable to associated enterprises. So the interpretation of this would be that for the purpose of calculating excess interest, you will have to take into consideration the total interest paid irrespective of whether it is paid to associated enterprises or not. In simple words, the total finance cost of the company or interest of similar nature will be your factor for determining what is excess interest. And it also makes sense because when I compute EBITDA, my formula for EBITDA doesn't allow me to differentiate between what is an A interest, what is a non-A interest. If I exclude only A interest, then it is not EBITDA in the true sense because I still have an interest component there. So when I am going to remove entire interest from the denominator, then it is natural that I have to include it in my numerator. So here is where there is an anomaly, because now going back to the tax audit report and the guidance note on what needs to be disclosed, I'll come back to that, but class 30A, so the institute guidance note says it refers to 94B1, very specific for responding to the first question here, whether the entity has entered into an expenditure. So that is very clear, it has to be an associated enterprise non-resident borrowing exceeding 1 crore rupees. Now the guidance note says, because you say a yes is where you answer the second part of it. So naturally, the amount of expenditure incurred by way of interest, which is clause 30B subclause B1, the amount of interest will have to refer only to the amount of interest being paid to non-resident associated enterprises. Which is a fair sense of interpretation, because I say yes there, only then I am answering this question. So interpretation seems to be right, and I would agree that I will have to disclose only the amount which is paid to non-resident entities, associated entities. Second question is pretty straightforward. It says total disclose the EBITDA as per the books of account is not the income tax return. So this is a slight deviation from the OECD regulations, because the OECD kind of prescribed that you will have to take tax depreciation into account and not a book depreciation. But it will create kind of an imbalance, because then I'll have to go from the taxable income and then do a reverse working of taking the interest as per the tax returns, going by tax depreciation. But in this case, we're going by the books, and the Indian Act doesn't provide you an opportunity to take the taxable income computation. So we go by the books. PBT as per the books, add back interest and depreciation. 30B3. Now this is where the interesting part happens, because my clause reads amount of expenditure by way of interest or similar nature as per one above, which exceeds 30% of my EBITDA. So now what happens, as per the Act, I am required to take total interest, which will be interest of AE plus non-AE, but my tax audit report says as per one above, which will only be my AE interest. To actually explain how this would pan out, let's have this example. For a moment, let's assume 30% of the EBITDA is rupees 100. And I'm not going to the EBITDA, I'm saying 30% of the EBITDA is 100 rupees. And I have four scenarios where the AE interest is 90, non-AE is 30. The reverse scenario, AE 30, non-AE 90. AE 10, non-AE 110, 110 and 10. In all the four cases, my total interest paid is 120. I have not changed the total number. I have just created different scenarios on what will be the AE interest and what will be the non-AE interest. So now if I have to follow the tax audit report guidelines, then what will I disclose in clause 30B1, I will have to disclose the amount of interest paid to associated enterprises only. Then it will be 90, 30, 10 and 110. Clear? No dispute here. But when I come to clause 3, which says excess of 30% of EBITDA and refers to clause 1 above, then my formula becomes 90 minus 100, 30 minus 100, 10 minus 100 and 110 minus 100. Because in clause 1 I would have reported that amount. And going by this, I will not have a disallowance in any of the first 3 scenarios other than the last one. But what does section 94B2 say?
Whichever is less.
It says whichever is less. Now if I use this formula, 90 minus 100 will always be less than 90. In all situations, interest as per clause 1 above in excess of 30% of EBITDA will naturally be less than my base number which I am considering. That's the second table here. In all the above instances, interest in excess of 30% of EBITDA will be lower. Then I am not actually giving effect to the second part of 94B2, whichever is lesser. In the ideal situation, what should have been the disallowance? My excess interest is 20, 120 minus 100. And then if I have to take the interest on age, it's 90, 30, 10 and 110. Then my disallowance will be 20 in the first case, 20 in the second case, 10 in the third and again 20 in the fourth situation. So because of reference to clause 1 in point 3, 30BB3, because it draws a cross reference to 1, I will be forced to disclose the total interest paid in clause 1. But now this will give a contradictory position because I am answering yes under 94B1, which is a non-resident associated enterprise. I have to say a yes, but the corresponding amount that I am going to give will be something way higher than what is actually being borrowed. So tomorrow if somebody is going to read the tax audit report, they will say, okay, you have an interest paid to the associated enterprise and this is the amount. But that amount is not actually what I paid to my associated enterprises. It is going to be way higher than what I paid to the associated enterprises. Alternatively, it should be a possibility that there should be no reference to clause 1 in subclause 3. In that case, what happens? The tax auditors, all of us will be forced to have a separate computation for 94B, work it out. My interest will be disclosed in clause 1 will only pertain to AEs, but I need to have a separate computation. What is the AE interest, what is non-AE interest, total interest, excess interest, and then bring in the disallowance here. That working will have to be part of our working papers, and then when there is a scrutiny and there's a question around this, we will have to submit that working saying this is how this number was arrived at. But as it stands now, this will be something that requires clarification, because from an interpretation, it makes absolute sense to disclose the amount of AE interest alone in clause 1. But from a computation perspective, that will not give me the right result of what is the amount that needs to be disclosed, because in all situations this will work in favor of the companies. But my law says excess interest or interest paid or payable to associated enterprise, whichever is lesser, and this computation will be in violation of that section because it doesn't compare at all. Yes.
If any loss, loss, if company make any loss, then now fully interest is sold.
Yeah, so I will come to that. So, okay, since that question has been raised, unfortunately, as the Act stands today, if the company is making loss, then you will not be able to claim any deduction, because 30% of your EBITDA will also be a negative number, so negative will be considered as 0, then everything will be excess interest. So while the intent of the section was to curb tax evasion and tax arbitrage, it eventually ends up in a situation where loss-making companies will not be able to claim any interest in their taxable income computation unless and until they make profits. They can carry forward for a period of 8 years with the whole business intention that they start making profits in 8 years, and then they are able to claim their interest deduction. Again, that interest allowance will be subject to them setting off their interest in that particular year. In the 8th year, I cannot go and set off my first year interest and carry forward that for another 8 years. It's a natural logic. Though the Act doesn't specifically prohibit me from doing that, it's normal sense, like how we do for your business profits, that you will take that year's interest first, because excess interest itself takes into computation the interest that you paid in that year. So then whatever is left, only that I will have to set off. So if the company is making loss, as it stands today, they will not be able to take any credit.
So this all the conditions like SSC, being a non-resident, AE, everything, it's only for the applicability of this section. We'll have to read it like that. Only for the applicability of the section, we'll have to look into whether it's a non-resident, AE, and once the particular provision applies, then we'll have to go for the total interest and then deduct whatever is less.
I would slightly reword it. I will say this section applies only to non-resident associate enterprise borrowings, because when I have a limitation of interest also, it is only restricted to my AE borrowings. Only for the purpose of subsection 2 computation of excess interest, I go to non-AEs. Otherwise, this section will not entitle anybody to disallow any interest that you have paid to non-AEs. You might have paid 100% of your EBITDA only to non-AEs. You then will still and paid probably only 10% to AEs. Your disallowance will be restricted only to that 10. The section does not go beyond its jurisdiction to limit interest paid to non-residents, interest paid to non-related entities. The section is always limited to associated enterprises and non-resident borrowings. For the purpose of subsection 2 is where I do
this. If you can go back to the section, does it say like the first sub-point itself, does it talk about this 10 million threshold?
Yes. So, notwithstanding anything, it's 1 crore rupees, the second line. Being the borrower incurs any expenditure exceeding 1 crore rupees.
So, this there is non-resident and the AE, I'm not able, AE clause also comes there.
Yes.
Can it be interpreted like in the sense like only if the interest to the AEs exceed 1 crore, I will fall under?
Precisely yes. Precisely yes. So long as my AE interest does, my first condition for applicability of the section is 3. It has to be a non-resident, it has to be an associate enterprise. I need to have paid interest in excess of 1 crore on those borrowings. I may have paid 5 crores, 10 crores, 100 crores to any other entity. But this section will apply only if this particular borrowing category, I have paid interest in excess of 1 crore. Only when this is satisfied, I go to subsection 2 and try to calculate what is excess interest. And there again, there is, at least in the initial stages, there was a discussion whether it should be AE interest or total interest, but from the reading of the act, because the second part where they had to refer to associated enterprise, the wordings have been included. So where it is not included, the intent is to take into consideration the total interest, and only then it will make sense, because for EBITDA I am taking off my total interest, then it has to be balanced in that particular way. Any questions so far on the 3CD clause amendments? And the last guidance which the ICAI guidance note gives is that it is suggested for the tax auditors to obtain a management certification from the company for the interest computation and the EBITDA computation, and just for your working papers, because though if it's going to be the stat auditor, well and good, because you have all the working papers, but if it's a different tax auditor, then you rely on the stat audit books, so you rather get your management certificate on what is the EBITDA, how that has been computed, what is the interest computation. Because why interest computation? Because what are those components which have been considered as interest or similar nature will be important in quantifying what is going to be the disallowance.
Similarly, if there is a particular deferred, even for purchase of equipment or for purchase, if there is a deferred payment schedule, which again due to IFRS or Ind AS, if it's been classified as interest component separately and the other components separately, even that could be added in interest.
That wouldn't be, because it will technically not fall into the definition of debt as per OEC.
That's what I want to know.
It will not, because that is more from an accounting standard perspective, where you are creating a bifurcation into what is the debt component, what is not. So that will not fall within the purview of this section. It will only be borrowings. Any more clarifications? Okay, so now let me throw up some discussion points of what will be the major issues around thin capitalization, and where will companies actually face challenge And the first point that I will start up with is what was already raised in saying what happens in case of companies which are making losses, which are making startups. He had an example of a construction company, infrastructure companies. You wouldn't find these companies making significant profits in any day. Then in that case, do you really say those companies shouldn't be borrowing? Not really the case, because for such high capital intense business, there would be a mandatory requirement for them to go for a borrowing. But unfortunately, as the section stands today, it will not be allowed a deduction, and they will have to carry forward and take a deduction later. There is also another challenge around this is where scrutiny happens later. At this stage, I would have computed what is deductible under PGBP and then claimed it. What if there is a disallowance in subsequent years during scrutiny? Then do I go and add this back? Is something that's not answered. Technically, yes, because the section computation requires it. But the only challenge will be, will the net result in increasing my total income? Then the assessing officer will not be in a position to do that. Or he would rather refrain from doing it, because at that stage of time you have to keep litigating that later. Another question will be, what is EBITDA? It is subject to a lot of discussions because the term EBITDA has not been discussed in the Act again. And do you go as per books? Do you go as per Income Tax Act? And from a plain reading, it is amply clear that it will be the books, because that is going to be the starting point of every computation that I make. So I will still take the books of accounts as my base for which I will do the computation of EBITDA. And what happens to exempt income? I would still say, for the purpose of EBITDA, it is always the books. So your exemption, non-exemption are all as per your Income Tax Act, and that would remain for a moment aside. And when you compute this 30% of EBITDA, it will only be by your books. And that is what the guidance of the institute also says, that EBITDA will be as per the books of accounts, and mind you, it will have to be as per the standalone books and not your consol books. So if it is going to be an Indian outbound entity and you are preparing a consolidated financials, it will always be as per the standalone books. What happens to the carry forward of disallowed interest? So let's take two examples. Say a company has an EBITDA of 200 negative in year one, which means 30% of EBITDA is 0, total interest is 100, excess interest is 100, so my entire 100 is going to be disallowed. I have a carry forward of 100 for the subsequent year. Year 2, 30% of EBITDA is 150, interest paid again remains 100, and I have a 50 which I kind of can carry forward. Now the Act doesn't explicitly prohibit me, nor does it say which interest should I set off. It says total interest in excess of 30% will be disallowed, and I already have a carry forward balance. So and I have a time clock ticking on it saying 8 years. So do I say set that off first and say I'll carry forward this portion later? Answer from a logical perspective would be no, but aggressively we never know. You can still take that position, it will be subject to audit, but this will work very much similar to your business losses, and you will naturally have to take the 100 rupees of that year, because when I'm calculating total interest paid in excess of 30%, again this has also been paid, but you are doing the computation for that particular year, and you will naturally have to set off that 100 first and then carry forward this for another period of 8 years. What happens to TP and 94B? So let's take this example of a parent company providing loan to an Indian subsidiary at MCLR of 12%, and the arm's length rate works out to 5%. And even after charging 5%, there is a disallowance. How much will be the quantum of disallowances in which section? I might have a disallowance in 92C for not conforming to the arm's length principle. I might have a disallowance under 94B for thin cap. There is no guidance on sequence. But because just notwithstanding anything in the Act, I would follow this rule that I will first make a suo motu adjustment for my interest, because if the company or the chartered accountant who is certifying the accountant's report itself deems that this transaction is not at arm's length, then he makes a voluntary adjustment in the return of income. And the minute he makes a voluntary adjustment in the books of income, then I'm not claiming a deduction. Then to the extent of 5% to 12%, the 7% will go as an adjustment on transfer pricing under 92C. And then the amount of excess interest from the 30% of EBITDA to 5% interest paid, that difference will go as 94B. There cannot be a duplication. For both purposes, they cannot start off with 12 and come back saying I will make an adjustment in either cases, but it wouldn't be restricted to one section. Now I will have to move to two sections and split my adjustment to one on 92C and one on 94B. And in most cases, what we discussed is I may be paying a huge amount of interest to my banks in India, mostly because the cost of borrowing in India is significantly high, and everybody would agree to that the interest cost in India is going to be significantly high for any entity that is borrowing. But merely because of that, this section will also trigger an adjustment in the hands of the company, because that amount itself, if it is going to exceed 30% of EBITDA, then my entire disallowance comes and falls on the head of my borrowings from the associated enterprises. I might be even getting a 1% loan from my parent company, which is absolutely arm's length, and I will not get a deal better than that when it is borrowing. But if I have a parallel loan running with the local banks, which constitutes say 30% of my EBITDA, then this is still going to be disallowed entirely, even though that is a beneficial interest for me, even though there is no arbitrage. I've actually paid at probably much lesser than what I will even determine as the arm's length interest. I will say maybe 5% is arm's length. I'm actually getting only 1, but I will still have a disallowance merely because my excess interest computation takes into consideration my non-A interest. So 2 examples that I've given. In the first case, the interest incurred for A's is 15 and interest incurred on A's is 20 and 35. I've kept the A interest constant, and then what happens if my non-A interest is going to increase? In either cases, there will be a disallowance because 30% of my EBITDA is 30 and I have a total interest of 35 and 50. Now what happens in the first case, at least I get a partial deduction of my A interest. 5 gets disallowed, 10 gets allowed. But in the second case, merely because I have non-A interest, and for it in all likelihood that amount is neither guaranteed and it is absolutely in a third party scenario, and there is no base erosion or tax arbitrage as well. It is everything within India, but still the entire interest that the company will pay to the associated enterprise will be disallowed for tax purposes. Now, when we talked about a situation where the company pays interest, claims a deduction that is not going to be taxed in the hands of the parent company, and the company claims a double deduction, now it will be a reverse situation.
So the intent is lost in this case, right? The intent is lost.
Sorry?
The intent gets lost in this scenario.
The intent gets lost in this scenario because now it will be a reverse situation where, assuming for a moment it is taxable in the hands of the parent company, then he pays taxes on his income. I don't get a deduction for this for a period of 8 years. And what if I am in a business that is capital intensive or that is on the down, and I am not able to foresee a profit for the next period of for a period of 8 years? Then I lose the claim for this interest as well.
Economic double taxation.
But we have to live with that.
Any representations have been made?
It can't be because, at least on this grounds, no. And it's only the ruling, the Gamesa ruling, which is challenging, saying this is exactly the situation that we're envisaging, because there is no, the exact situation for Gamesa is the second one.
The exact one.
So there the point is, the interest which I'm actually incurring in excess has no tax arbitrage. It is entirely within the domestic regime. But I am now being penalized for the other borrowing, which is at arm's length, which has been certified to be at arm's length, which is not even in excess. So that is the primary ground on which they challenge this writ, and we will have to wait for the ruling of the Madras High Court to see if at all there will be any amendment to the Act, or will they even suggest for it. Okay, the last part that I will cover in thin cap today will be non-discrimination. A little bit far-fetched, but I really thought I would take your inputs on how many of this group of members here believe that this would fall within the ambit of Article 24 of the Model Convention and say it's a discrimination. You believe? Okay.
Exactly for the slide which we saw, right?
Sorry?
Exactly for the reasons being the slide which we just saw. The Gamesa case, like.
Okay, so see, from a plain understanding, yes, because Article 24(1) clearly says that the resident of one contracting state shall not be put to a burdensome tax as compared to the other residents of that particular contracting states. But to look at it from the department's perspective, I would say those loopholes have been plugged. The reason being that Article 24(4) of the Model Convention, it excludes only situations under 9(1) and 11(6). 9(1) is on account of arm's length, 11(6) is also on account of arm's length, where it says the amount of interest that has been disallowed for want of arm's length will not get the beneficial rate of tax under the treaty. Now, where the transaction is at arm's length, does this tantamount to violation of Article 24? You can still say, yes, there is a discrimination between residents and non-residents. But 24(4), which talks about interest, royalties and FTS, says the difference arising on account of the situs of residence of the particular entity. Now, Section 94B has not been drafted and the interest is not being limited merely on account of the situs. I am not disallowing any tax or any amount of interest that has been paid to non-residents. I have a clause where there is a requirement for a non-resident borrowing, and it is also because of the relationship with that associated enterprise that I am limiting this interest. Then have I bypassed 24(4). Now let's come to 25(5). 25(5) is the clause of the treaty which says that the benefit, the difference or discrimination shall not be on account of one entity holding the capital in the other entity on account of ownership of capital. So same royalty, FTS and interest, there shall not be a differential treatment merely on account of one entity holding the capital in the other entity. But the challenge here is associated enterprise term definition is not just capital ownership. My definition of associated enterprise is way beyond just ownership of capital. Control, capital and management. Capital is only one part of what I define as associated enterprises. I have management, I have control, and my definition of associated enterprise for this section is also going to draw reference only to 92A. So then, and again 94B, let's take situation, put other associated enterprises aside. Will I say only in case of say my parent company bringing in this borrowing, can I say only in that particular situation does it violate Article 25(5)? No, again, because the commentary says thin capitalization regulation does not violate 24(5). Thin capitalization does not violate 9(1) also, it does not violate 24(5) also. So the department intentionally or unintentionally have actually plugged all the loopholes. Now the only argument that the company can take here is this strictly a thin capitalization regulation in place? This section is more of a limitation section in terms of the allowability of expenditure. And it's a special provision, special anti-avoidance process. It is not a thin capitalization regulation as such. If you are able to bring that argument and demonstrate, then maybe for the limited purpose of your parent company who's owning capital and then is being treated differentially, you can maybe invoke the non-discrimination clause, but highly unlikely that the department will accept that chance, because they will still come back and say all the clauses have been accordingly caveated, because the commentary of the Model Convention and the article doesn't clearly say that, because Article 9(1) and 24(5) permits thin capitalization.
The Memorandum of Finance Act refers to BEPS.
It does.
So then again.
So that's where I'm coming. So once you say thin capitalization is permitted and will not be in violation of Article 9(1) or Article 24, even though this thin capitalization regulation that has been introduced in India does not prescribe a debt equity ratio. It does not say what is a thin capitalized entity. It does not say what is the optimum amount of debt or equity that should be there, and it only limits my interest. It creates a disallowance, and which also allows me a set off in the subsequent year. So ineffective, if I make sufficient profits, I might not even have a disallowance if I have to look at it at a block of 8 years. But still, the memorandum refers to PEP's action point 4 and thin capitalization. In that case, they will say the intent of introducing this section is thin capitalization, and then there will be no violation of Article 24. So now this could be one of the talking points in the Madras High Court ruling as well. The only difference being that they have gone on the constitutional validity that there is no arbitrage in my borrowings from domestic taxes, and they have not specifically harped on this issue of a discrimination under Article 24 of the Model Convention, because there is no non-resident entity being disputed there. Just for references, I put in the slides. Maybe I will have this circulated to everybody to have a reading. So the particular points that I was referring to on 9.1, if I can just take you down to the commentary, it says, the article does not prevent the application of national rules on thin capitalization insofar as their effect is to assimilate the profits of the borrower to an amount corresponding to the profits which should have been accrued in an arm's length situation. So Article 9.1 here permits thin capitalization. I have 24.1, which is the straightforward definition saying there shall not be any discrimination, but 24.4, I will say, I am reading from the second line, except where provisions of paragraph 1 of Article 9, 6 of Article 11 and 4 of Article 12 apply. Interest, royalties and other disbursements paid by an enterprise of a contracting state to the resident of the other contracting state shall, for the purpose of determining the taxable profits, be deductible under section, Article 24.5 is where it says, by one or more residents shall not be subjected in the first mentioned state to any taxation or any requirement connected therewith which is other than or more burdensome than the taxation to which other similar enterprises. Is exactly what I was mentioning, where merely by reason of situs or merely by reason of holding capital is not this disallowance. There are other conditions around it, and this will not be a section that is a pure and pure violation of Article 24. Any questions? I would be happy to take. Okay. Now the second baby of transfer pricing, secondary adjustments. Once again, I would technically put it as a surrogate baby from OECD, but as it stands today, it is once again a legally enacted section in the Indian Income Tax Act, and that would also be equally important for all of us to understand what is secondary adjustment. Secondary adjustment, in most cases, what has been wrongly interpreted is that the rule says there should be interest if there is no repatriation, and in everybody's mind, what has gone is that that interest is secondary adjustment. But that is actually not the case. Secondary adjustment is that particular entry for you to bring that money back into India. Now, why is this required, or why are entities enforcing a secondary adjustment? The OECD report 2017 also permits secondary adjustment. It says it is up to the tax administrations to see whether they want to charge a secondary adjustment. But the whole idea is that if I had transacted at arm's length, then that is the money that would have been available in that particular country. Now it has two benefits. One is taxation, because once that money is in India, if it has to go out, it will be subject to taxation, either by way of withholding tax or dividend distribution taxes. Or if that money stays in India, there is a forex movement. So from an economy perspective, also I have movement of forex, which is equally important for the economy to be able to sustain. So in both these conditions, for the mere reason that the transaction has not been entered into in an arm's length scenario, there is a shortfall in the amount that is being repatriated into India. This is the primary intent with which this section has been enacted. And prior to this section being enacted once again in Finance Act 2017, there have been a lot of rulings where there have been situations where the assessing officers have kind of brought in their own interpretation or or a limited secondary adjustment in certain cases, and this has been shot down by the courts in the prior years, saying the Indian Act does not provide for secondary adjustments, therefore the assessing officers shall not be able to make this adjustment. This was precisely something that came across before the amendment in 2012 for the section 92B, where overdue receivables was being treated as an interest was being alleged earlier, prior to the amendment of the Act. And when in 2012 Finance Act section 92B was introduced and said it covered any advance and not restricted to only borrowings, then overdue receivables got covered. Because prior to that, overdue receivables was also more of a secondary adjustment nature, because you have not received this money. Let's say, to put it in simple terms, the Indian company has sold X amount, goods amounting to X to its parent company, and it has not received that money for a particular period of time, let's say 90 days or 120 days as per the company's policy. The assessing officer, prior to the amendment of section 92B by Finance Act 2012, they made this adjustment. They said you should have received it within 90 days, you've not received it for 120 days, I will levy an interest component for 30 days. But this was again more like a secondary adjustment, because the primary international transaction that was being subjected to scrutiny was the sale and not my receivables. And then these were struck down by the court, saying this section did not provide for secondary adjustments. Then 2012 Act amended section 92B to say any form of advance which included trade advances, and once I have a debit balance, in all logical sense it could still be considered as an advance, and then overdue receivables was becoming a transaction that was subject to scrutiny and transfer pricing. And my 3CBs today will also require me to report what is overdue interest and what is overdue receivable or payable, and be able to test the transaction. So now what happens, in 2017, the Act has legally brought in a secondary adjustment also, where I will have to repatriate this money back to India. So this secondary adjustment is again not a concept that is new to India. This is a concept that has existed across the world, probably not as much as the thin cap regulations existed. So if say for example, I'll say 20 countries had thin cap regulations, maybe 5 countries had secondary adjustment, roughly. But this is again a concept that is not the first in India, and it exists in different countries. And the OECD and the practice that has been followed in many countries will suggest that there are 3 different methods in which you do this secondary adjustment. One is the equity method, where because there is a balance available with your parent company or your associated enterprise, it is treated as a deemed equity. So what will happen, the secondary adjustment will be, I will go and adjust this amount against my equity. This will reduce my equity balances, and this will have subsequent impacts in my valuation and the capital contribution of the company, of the parent company. But it will not be favorable in all situations, because what happens if my transaction is not with my parent company? I can have transactions with any other entity, and then I cannot follow deemed equity because that entity doesn't have equity contribution in it. Then how do I bring in secondary adjustment? Then this method becomes redundant. I will not be able to use this method. Also for the reason that the tax department doesn't believe in the equity method, because this doesn't yield any benefit to them. I'm going to go and adjust my equity, there is no tax bearing on it. Unless and until I'm going to have a winding up and then I have all the other regulations, there is no impact on the equity method. So this method is the least preferred method when it comes to secondary adjustment. The most widely used method will be the third approach, which is the dividend approach. The dividend approach is more of a logical approach. It only says, had you transacted at X amount, that money would have been in India, that money would have been in your PBT, repatriation would have been through dividend. That amount, pay withholding taxes on deemed dividend. Simple logic, widely accepted across all countries. But what is the impact here? I will have impact only on 1 year. The year in which I have the primary adjustment, I will have this impact. I will have to pay dividend distribution taxes, done. I will not repatriate that money at all. So if I don't believe in that adjustment, or my parent company is going to say, no, I will not be paying you this money because that is an adjustment that is being made in your country's jurisdiction, fine, I will pay my dividend distribution taxes, 20%, I'm done. I would have anyway done that had I had this money also. The third approach, the most aggressive approach from a tax department perspective, is the deemed loan. In this approach, this excess money which is available with the associated enterprise is considered as a loan given by you to the parent company or the associated enterprise. And if you don't get this money back within a particular period of time, you charge interest on it. Now this method will have cascading effects till the year I receive that money. So today, if I have a deemed loan approach and my associate enterprise say, no, I will not pay you this amount, my job doesn't end that year. I will continue to pay in taxes on an imputed interest until the day I have to bring this money. Or I bring it to the books, I create an advance, I do a write-off, again that is going to be subject to transfer by the scrutiny, it will be disabled. Once again it comes back as a primary adjustment, I have a second adjustment, I will keep running in loops. So I will have no end to this approach unless and until I bring that money into India. I will be forced to. And as expected, this is the method that India has adopted as the deemed loan, and 92 CE was introduced in India. Just an explanation of what I already said, the deemed loan approach, deemed dividend and capital contribution approach. So section 92 CE was introduced in 2017 Finance Act, and it says secondary adjustment would have to be made where there is a primary adjustment on account of 5 conditions. First condition is there is a suo motu adjustment by the company in its return of income. Straightforward, the company itself believes, or in the purest sense, the chartered accountant certifying the Form 3CP believes that the transaction is not at arm's length. I make a voluntary adjustment in my return. That is the primary adjustment. Second, an adjustment proposed by the assessing officer has been accepted by the assessee. So I have an assessment, I have a transfer pricing adjustment. Technically, secondary adjustment will not be applicable because I may not accept that adjustment. I will go on appeal, DRP, CIT appeals, ITAT, High Court, Supreme Court, but that is where it ends. At some point of time, once that adjustment is sustained and I have a notice of demand and I pay that demand, then my secondary adjustment kicks in. Third condition, APA. Fourth condition, MAP, safe harbor. Fifth condition, MAP. All these are different transfer pricing regimes which help companies get certainty on what the transfer price will be and what is the price at which the transactions will have to be transacted with the parent company. In either case, if there is a primary adjustment is nothing but a difference between your transaction price and your agreed arm's length price. So if there is a primary adjustment, then I need to repatriate that money. But the definition of secondary adjustment here, it says, secondary adjustment means an adjustment in the books of accounts of the assessee and its associated enterprises that the actual allocation of profits between the company and the AE are consistent with the transfer price. So secondary adjustment doesn't mean the interest, it means me creating a book entry to be able to repatriate that money into India. And then 92CE goes on to say that if within 90 days from a particular date, if this money is not repatriated into India, I will have to levy an interest on such amount. And when the section was introduced, this date was not prescribed. Subsequently, CPE circular was introduced, and the due dates prescribed here are what came in the first circular. There is a modification to it. I will deal with it in the subsequent slide. But the initial rule said, for a suo motu adjustment, 90 days is my time limit. I have to bring the money within 90 days from the date of filing the return, or rather due date for filing the return. So technically, even if I am very compliant and I file my return way ahead of the due date, I still have timeline until 90 days from the due date of the return. For the acceptance of adjustment from the date of the assessment order or the appellate order, whichever is final. If there is an appellate order and there is an OG that needs to be given, then your OG date, the order giving effect date, will be considered as the final order. It is basically that order which triggers your demand. APA, MAP, safe harbor, everything said 90 days from the due date for filing the return under section 139(1). Then the proviso is the proviso which says that to whom will this section of secondary adjustment be applicable. First condition, minimum transfer pricing adjustment of 1 crore rupees, mandatory. If my primary adjustment is less than 1 crore, then I need not make a secondary adjustment, but primary adjustment is aggregate. So if I have 10 transactions, I make 10 different adjustments, each of it less than 1 crore, but if aggregate exceeds 1 crore, secondary adjustment is applicable. The second condition is secondary adjustments will not be applicable if the adjustment is made for a year commencing on or before 1st April 2016, which is up to AY 2016-17. Secondary adjustments will not be applicable. It is applicable from AY 2017-18 onwards, which is financial year 16-17. So two conditions: one is 1 crore rupees. Second, it has to be for financial year 16-17 onwards, and the section comes into effect from AY 18-19, which means the adjustment should happen in FY 17-18 onwards. So adjustment made from FY 17-18 onwards for AY 16-17 onwards in excess of 1 crore rupees, secondary adjustments will be applicable. And then sub-rule 2 says that if I don't repatriate this money within a particular period of time, I will have to charge interest on that. And what will be the interest? Subsequently got notified in the rules, and it said if my transaction is denominated in INR, my interest will be the marginal cost of funds lending rate of SBI, MCLR rate, plus 3.25%. If my transaction is going to be in foreign currency, I use a 6-month LIBOR plus 300 basis points. And the only difference is that SBI MCLR should be taken as of 1st of April, 6-month LIBOR will be taken as of 30th September. Which also makes sense because if my secondary adjustment is treated as an advance, my interest rate should correspond to the currency in which the borrowing will be. And if I have to borrow in INR, my SBI MCLR will be the rate with which I will benchmark. And if it's a foreign currency, I will benchmark with LIBOR. This is the ruling that's been given in various tribunal rulings, that your benchmark should be based on the currency of the transaction and not anything else. Because there's always been a dispute that if I pay more so with outbounds, that if I charge interest of LIBOR plus 3, then the department says no, it should be 8%. So it's always benchmarked with respect to the currency. Now, what was the amendment which came in the rules to the change that was made was the days which were proposed for the APA and MAP. So APA, I sign on a particular date, and then I have 90 days from the end of the month in which I sign the APA to file my modified return. That is under 92 CD. Technically not 139.1. My modified return will have to be filed as per 92 CD. So then if I say my due date will be for an APA or an MAP under 139.1, it doesn't really correlate. So they made a modification to say for APA, the date shall be 90 days from the date on which the APA has been entered into. And for MAP, it shall be the date on which I agree, or the date on which I agree to it and the assessing officer gives effect to it. So in an MAP, there is no agreement that I sign into. So once, how an MAP works is, both the competent authorities of the two countries will meet, they give a position paper, I have to file my acceptance to it, and then based on that, the assessing officer passes an order. So once I receive the order, that is the date on which my start point for 90 days gets triggered. Now, there will be a cushion here because for APAs, the only difference is that I have to file a return within 90 days from the end of the month, but for repatriating the money, I have 90 days from the date. So for companies which sign APAs on the first week of the month, unfortunately they have 20 days lesser to repatriate the money. But anyways, 90 days still stands as it is. Probably I will say that's a better cushion for them to file their returns, that they have 20 days more. So technically, just as a summary, it applies from AY 18-19 onwards, for AY 17-18 onwards, and where the amount of such adjustment exceeds 1 crore rupees. So no secondary adjustment can be imposed for previous years 15, 16 or earlier. And where the transfer pricing order is appealed, then the time limit shall commence only after the appeal gets finalized. So now what is acceptance is it's a question that remains unanswered, because in all logical senses when I say acceptance, I do voluntarily. But in 98% of the cases I wouldn't voluntarily accept this. If it is a fact-based issue, I cannot go beyond the ITAT. ITAT is my last fact-finding authority. I am forced to take that demand. Or even if it is a question of law, High Court, Supreme Court, beyond that I cannot go. So technically I have not accepted to the adjustment. But in that case, then there will be no secondary adjustment on assessment, because everybody will say, no, I don't accept to this. It is only under protest that I am paying this amount. So for all purposes, acceptance would mean the date on which you have to pay the demand and you don't have any further appeal left. In all other cases of voluntary adjustments or AP, the company agrees to it. So there is no question of acceptance. It's only when it comes to the assessments. A few case studies again, more so from understanding how will be the impact of secondary adjustment in the books of accounts. So first situation is where I have a transfer price of 100, but my sales is 120, profit is 20, and my arm's length price is 100. So my transfer price and arm's length price are the same. There is no primary adjustment, so there is no secondary adjustment required. In the second case, what if my transfer price is 115? Then I have a primary adjustment of 15 from the arm's length price and the transfer price. Now this 15, I will have to create a secondary adjustment. If I repatriate it within 90 days, I still have 90 days to pass that entry. I don't have to go on day one and pass an entry in my books, because if I repatriate the money within 90 days, I technically will not have the need to impute interest. So on the 90th day, if I receive the money, I can pass the entry on the 90th date also and say, debit my bank, credit my P&L account, that's a receipt from that day. Now from an accounting perspective, on the income side, this will be a prior period item, because I would be receiving the money for a year that has already gone by, and the matter ends the day I bring this money. Now what happens if I don't repatriate within 90 days? Then I pass an entry, and this entry cannot be on the 90th day, because the minute I don't bring the money within 90 days, my interest kicks in from day 1 and not day 91. Once it's deemed as a loan, I levy interest from day 1. I don't give a moratorium period for that loan. So then I need to pass an entry on the day on which this adjustment happened, the day on which the secondary adjustment kicked in. I will pass an entry debiting my associated enterprise and sales in advance, and again credit my profit and loss account and keep it as a prior period item once again, because it doesn't pertain to that year. Then I need to keep levying interest. To explain how the primary adjustment will work, more so from a timeline perspective, I have a company, let's say, that's rendering market support service of 10% in the ALP is determined as 16. I have a primary adjustment now to the tune of 6%, and let's say it exceeds 1 crore and I have a requirement for a secondary adjustment. And it's been made suo motu by the company on November. So I have 90 days from the due date of 30th November to bring in this money, and if I bring that money within February 2019, then there will be no secondary adjustments. If the answer is no, then secondary adjustment will be imputed from 30th of November 2018, which is the day on which I had the primary adjustment took place. So I will have to report it as an advance. Interest will be imputed from that date. Interest income will have to be offered to taxes. Interest income will be imputed for FY 19-20, offered to taxes, so forth until the day I receive the money. Now, if no secondary adjustment is made at the time of return filing, and say that happens 1 year, 2 years later, subject to a transfer pricing audit, or 3 years later, subject to multiple appeals, and let's say no secondary adjustment, if the order is, and the assessment order is passed in October 2020, then there will be no secondary adjustment if the money is repatriated by January 21, because I have again 90 days. If I don't, secondary adjustment will apply in FY 2020-21, because October 2020 is the date on which my primary adjustment kicked in. And then I have FY 2020-21, which is the year on which secondary adjustment becomes applicable for that particular transaction. Then, such adjustment, if the interest is repatriated in 2020, or let's say if the amount is not repatriated, secondary adjustment will be made until March 21 for 6-month period for that year, then for the next year. So the simple point is the date on which my primary adjustment kicks in. That will be the date, that will be the year in which I will have to offer that interest also for taxes. There is no question of going back and revising your returns. You don't have to do that because primary adjustments are made in the secondary adjustments are made in the year in which the primary adjustment happens. And when I charge interest, I don't have to go back to my old years and then revise that money because I am actually not levying interest for that period. I am levying interest only for the period in which I have not repatriated the money, which is the current year. So my repatriation will be restricted to that particular year. So now from a tax audit perspective, again 30A clause introduced. I would say this has much lesser points for debate than the thin capitalization regulation. The first question, 30AA, is whether primary adjustment to transfer price as referred to subsection 1 has been made. B, under which section of subsection 1? I have 5 possible options in which I could have made a primary adjustment. Suo motu adjustment, assessment, APA, safe harbor, MAP. I have 5 possible ways in which I could have a primary adjustment. What is the amount of primary adjustment? Whether the excess amount available with the associated enterprise is required to be repatriated, yes or no? If yes, whether the excess money has been repatriated within the prescribed time, and if no, then what is the interest that has to be imputed on such excess money that has not been repatriated. The issue is whether the aggregate of all interest paid to non-resident days have to be considered or payable to each non-resident has to be ascertained for the limit of 1 crore. The question is in terms of the primary adjustment, and as it stands it only says primary adjustment, and which will be adjustment for the company as such. So if I have 10 different days, even though the value doesn't exceed 1 crore for each of them, if it exceeds in aggregate, secondary adjustment becomes applicable. Now what does the tax auditor have to do? 30AA. What does the question say? Whether primary adjustment has been made to transfer price as referred to in subsection 1. Now, if I have to draw the difference between 94B1 and 92CE1, my conditions of 1 crore non-resident and associated enterprise was part of 94B1 itself. So in that case, I restricted my yes or no to only those situations. But 92CE1 doesn't talk of any limits. It only says where a primary adjustment has been made on account of the following A, B, C, D, E. So here the answer will have to be a yes, irrespective of the amount, irrespective of the year, because the condition of 1 crore rupees and the applicable years are provisos to section 1. And it only says it will not be applicable. So the proviso that this section will not apply if this is the case. So whether a primary adjustment has been made, yes. It is only the applicability of the section that has been given under the proviso saying nothing contained in this section shall apply if less than 1 crore pertains to a different assessment year. So for the purpose of
If
3.
it pertains to earlier assessment year also, still we'll have to mention this and then
Yes. So irrespective of the amount, irrespective of the year, I will still have to give a yes if I have a primary adjustment. Second point. So I give a yes, let's say for example. If it's a no, I don't have to answer the subsequent questions. If it's a yes, under which subsection of subsection 1 of 92C is the adjustment made? I will have 5 options. A, B, C, D, E. I will have to choose the option. That's a pretty straightforward answer. Third question. Whether excess money available is required to be repatriated as per provisions of subsection 2 of 92CE. So this is the clause where you have to take into consideration whether the amount exceeds 1 crore, whether it pertains to AY 17-18 onwards, and then disclose the amount. So if I have a primary adjustment, but I don't have an amount in excess of 1 crore, or it pertains to an assessment year prior to AY 16-17, then whether the amount has to be repatriated, my answer will be a no. So I will say a yes for 30AA, but I will say a no for 30B3, 30AB3. Clear? Any doubts here? Then I come back to the fourth, where if I have to repatriate the money within 90 days, the answer should be no. If I have to, if it's a yes, I have to say it's a yes. If it's a no, then I have to charge interest. If I say yes, it has been repatriated, question ends there, I don't have to answer the fifth question. If it's a no, then I have to quantify what is the interest that I will have to impute on such secondary adjustments. Now, tasks for the tax auditor will be obtain a certificate as to what is the TP adjustment that have been made, because it is only subject to what information that the client is going to give you, and in all cases, if we don't
previous whether it has money has been repatriated or imputing the interest. Suppose it's a voluntary motor adjustment, I still have 90 days, so I don't have to necessarily, even if the zero motor adjustment exceeding 1 crore for the current year, then the amount of imputed interest on such excess money, I'll have to say no, nothing, right?
The only thing is that we are doing now this for FY 17-18. So my so amount adjustment will be for the previous year, not this year. So this year's primary, if you are talking about so amount adjustment made in the return for 17-18, that primary adjustment happens in 18-19. You will report that in next year's 3CD.
Okay.
The year of primary adjustment is what will be considered for the purpose of 3CD. So the amount of primary adjustment that we will be discussing in the tax audit report for AY 18-19 will be primary adjustments for AY 17-18, made in the return in the previous year. So that is why that 1 year cushion was kept for the applicability of the section. Adjustments made from AY 18 onwards for AY 17-18. So the primary adjustment for AY 17-18 would have been made in November 2017, at the time they filed the return. That is what we will be reporting now in this tax audit report. So 90 days would have been passed. We will be able to ascertain it. So the tax auditor should get a certificate for what will be the transfer pricing adjustments that have been made, and if possible verify that records with whatever is available with the company. And the tax auditor shall also obtain a computation of a certification of the interest that is being computed, because in all cases it may not be the tax auditor who will compute the interest, it will be given by the company, and we will have to verify the interest computation, whether the dates have been taken appropriately. In most cases, the most likely mistake would be 91st day or first day. So that is where we will have to exercise caution. Any questions so far? So now I have a lot of points for discussion when it comes to secondary adjustments. And the biggest of the issues, 222E, deemed dividend. So 92C says, when I don't repatriate that money within 90 days, it shall be deemed to be an advance given by the company to its parent company. And then 222E provides that where a company makes a payment by way of an advance or loan to a shareholder beneficially holding more than 10%, it will be treated as a deemed dividend and taxable in the hands of the shareholder. So when I don't repatriate this money, I have to impute interest. Does it automatically trigger 222E of deemed dividend? Ideally, this would be a situation that nobody would want, but it's not answered. It still remains. I would be happy to take anybody's opinion, but if I have to just go by the act, yes, I am accepting it as an advance. I am going to create I am forced to create an entry as per 92C in my books and create an entry saying debit my associated enterprise, credit my profit and loss account. The minute I record this entry, then am I automatically triggering a 222 deemed dividend issue? Yes or no? Likelihood, you will have this thrown up by the assessing officer, and then you will have to go and fight saying, no, this is a mandatory requirement for 92C, and therefore you cannot impute 222E. It will only have to be litigated.
It says any payment, right? We start with any payment.
Split the two transactions if it's a purchase transaction. The point is valid in case of a sales transaction. If I am selling, say, 100 rupees and the arm's length price is arrived at 120, I have to bring in 20 rupees. But in that case, I have not paid anything to my parent company. It is only something that I have not received. What if it's a purchase transaction? I have paid 100 rupees, the arm's length price is 80. Then now I have 20 rupees which I have already paid to my parent company. In all my payable transactions, I will still have an issue of 222 left. Because that is the money that is already available with the parent company. And that's amount I already paid. Yeah? Extraterritorial powers. So 92CE2 and the definition of secondary adjustment says an entry in the books of accounts of the SSE and its associated enterprises. Does the Income Tax Act have the power to enforce an entry in the books of a parent company which is not a resident in India, is not taxed in India, or not a tax resident of India?
And more so, what is arm's length from India's perspective may not be an arm's length for.
Definitely not.
So it's like they may be violating their own laws.
But at least there I have a provision where I litigate it. But by bringing a section that there should be an entry that needs to be passed, and that entry is not restricted to the SSE, it is saying and its associated enterprises. Does the Act have the power to create an entry in the books of my AE? The answer will be no. But from an interpretation, if I have to repatriate that money, my AE will invariably have to pass an entry. The minute he makes the payment, he has no option but to create an entry. But what happens if I don't repatriate that money? I will continue to keep paying interest. I will create an entry. But does the AE create an entry or not? Nobody knows. How will somebody verify this part of the Act which says I have to create an entry in the books of accounts of my AE? I might not have access to books of accounts of my AE.
Confirmation?
Technically, the AO can use information exchange and ask for the books of accounts of the parent company and then see if they have passed. Okay, if he hasn't passed, what is the impact? I am anyway offering that interest for taxes. So, what is the legal sanctity of specifically saying pass an entry in the books of accounts of the AE is something that's unknown. The minute you say repatriate the money, the minute I bring the money, the AE is going to pass an entry. So, that particular part of saying pass an entry in the books of accounts of the AE is something that is still unanswered as to why.
See, we should be fortunate that it is not part of Form 3CD.
Sir?
We should be fortunate that it is not part of Form 3CD.
Actually, because it will be very difficult for the tax authorities to verify, because the department has the powers to at least use information exchange and call for that information, not enhance the tax auditor. Second question, what if the primary adjustment to the Indian entity is not accepted by the foreign company? Then do I say that forever I will keep paying interest? I can't do that. Now, how many years will I keep carrying forward this? How many years will I keep paying interest? And the adjustments that we're talking about in transfer pricing are generally not small. I have huge adjustments, crores and crores of money that goes in, and even if I have to pay SBI MCLR, which is on the average of around 9% plus 3 basis points, and I'm paying 12% interest on crores of money every year that I'm not repatriating this money. On the flip side, what happens? Okay, the associate enterprise pays me that money. What happens to his transfer pricing jurisdiction? What if that jurisdiction comes and challenges me saying, why have you made this excess payment? Or let's say in transfer pricing, we have this range concept where I have a 35th percentile and 65th percentile. And that is only in India. Outside India, it is 25 to 75, interquartile range. Say the payment has been made and to me it falls narrow to the 35 and to him it falls narrow to the 75. And by virtue of this primary adjustment, it throws out of the range. What was earlier a proper arm's length transaction for the foreign company, merely by virtue of this secondary adjustment, will become a transaction that is not an arm's length. Then what happens to the litigation in the other country? Only solution to this is MAP.
MAP or bilateral AP.
Bilateral?
AP.
Yes. For assessment, it has to be MAP, and your Article 9(1) also allows secondary adjustments to go. It doesn't stop you from going on an MAP for secondary adjustments. What will be the implications of 115 JB? The year in which the primary adjustment happened is the year in which I create this entry in the books of accounts. Then my PBT is going to significantly increase. And my 115 JB is a very clear act which gives me specific inclusions, specific exclusions. And your primary adjustment that is being made is not a part of your exclusions and inclusions. Then a company which is into a taxable loss, by virtue of having suffered a transfer pricing adjustment in X year, having to offer that primary adjustment for taxes in that year, having to pay interest if it is not repatriated within the particular period of time, will now have to pay MAT if it becomes a book profit merely by account of this primary entry. This may not likely be the scenario if it is an adjustment on account of an assessment, because the impact will be only for 1 year. Generally your APAs, MAPs which get concluded for a block of years. If I file an APA today, it takes me 3 years, 4 years to conclude the APA. And then I create a primary adjustment for 4 years together on year 4 or year 5. That could trigger a situation of MAT. Simply because of volume of 4 years transactions having accumulated in 1 year, my taxable loss can become a book profit and I will be paying MAT under 115 GB. And there is no way out here because two different sections, computations are clearly driven, and I will have to pay MAT, and I will not have an option to escape either of it. What happens to primary adjustments between two non-resident entities or in case of a flip transaction? Say for example, the Indian company is paying royalty or technical service fee to its parent company. That income is taxable in India. That associated enterprise will file a return of income in India. Let us say that is subject to scrutiny in India. And in most cases, practically, having handled assessments, if the Indian company as well as the parent company are both subject to scrutiny, they don't make an adjustment in the hands of the foreign company. It will have a cascading effect here. But what if the Indian entity is not referred to scrutinized for assessment? There is only one end of the transaction that is being now scrutinized, and nothing stops the assessing officer from saying that no boss, your transaction is lesser, because if he says royalty is 100, no, royalty should have been 200. He will still tax 40% of that for a non-resident. Then what happens to 92 CE? There is a primary adjustment, but will 92 CE apply or not? The answer to that will be no, because section says there is money to be repatriated into India. Now, if the assessing officer is going to say your royalty income should not have been 100, it should have been 200, then there is a requirement for repatriation of money outside India. If I have to bring in money into India, then the parent company should pay itself in India, which is not the situation. So technically, you are not satisfying the condition of having to repatriate money into India. And for that reason, you can say section 92C will not be applicable. This is possible in case of transaction between two non-residents, which is taxable in India subject to transfer pricing. It will be the same logic, that there is no need for money to be repatriated into India. What happens to a reverse scenario? Say for example, I am paying a particular service fee to my parent company at 100 rupees. It is being subjected to transfer pricing in India, and the officer says it shouldn't be 100, it should be 80. I have a secondary adjustment for 20 rupees. The same transaction is subject to scrutiny in that particular country, and that country says it shouldn't have been 100, it should have been 120. So on one hand, I have one country which says bring in 20 rupees that you paid excess. On the other hand, you have the other country which says you already have 20 less, now bring in 20 more. Now I am having a gap of 40 that I am trying to bridge now. Who pays who? What if that country has a secondary adjustment requirement? Not all countries have, but hypothetically, if that country has a secondary adjustment, both countries will be paying taxes, both countries will be paying interest, and there will be no resolution here. Unless and until you resolve it through a MAP will be the only option that is available with the company. Let the two competent authorities decide which country will pay how much, what will be the amount. Until the resolution, it will keep going. So then the only option is file an MAP, then you have not accepted the adjustment, secondary adjustment doesn't kick in, you have 90 days until the date of which the OG is passed, keep your buffer. Depending on what is the outcome of the MAP, who will have to pay the taxes.
In case of deemed international transactions, so in this case, it is going to be a third party. Only that since it's through the transaction is controlled by some associate enterprises, it's been deemed to be an international transaction. In that case, it will be even more funny, right? You're paying, say, this.
Interesting question. I would be dealing with that myself, and how having raised that. Let's read 92C and let's say 92C2. It says, where as a result of primary adjustment to the transfer price, there is an increase in the total income or reduction in the total loss as the case may be. The excess money which is available with the associate enterprises, if not repatriated to India within the time, shall be deemed to be an advance. Now, in a deemed international transaction, the transaction happens between an entity and a third party because it is controlled by an associate enterprises. 92CE2 says such excess money which is available with the associated enterprise. So in the 92B2 transaction, the transaction is between the non-resident, there is no excess money available with the associated enterprise. So I can still take a position that secondary adjustment will not be applicable.
Okay.
Because there is no excess money with the associated enterprise. If at all there is an excess money that is available with the third party and not my associated enterprise. So then 92C need not be applicable. What happens in case of a PE attribution? Let's say there is a particular entity in India and it triggers a DAPE, dependent agency PE. I make a adjustment, and for all practical purposes that adjustment is being made using transfer pricing principles. There is a functional analysis that has to be done, and a proper TNMM or profit split method is what is generally used to attribute profits to India. Is secondary adjustment still applicable for that?
It's like P in the sense one arm giving the other. It's like the same entity.
In case of a dependent agent P, let's say it's not the other service P or anything. Dependent agent P, you have another entity. You have to repatriate money into India. So in that case, again going to the Act, the definition of primary adjustment says primary adjustment to a transfer price means the determination of transfer price in accordance with the arm's length principle resulting in an increase in the total income or reduction in loss. And 92C applies only when there is a primary adjustment to transfer price. So in case of a PE attribution, what I am doing is more of an income attribution and not an adjustment to transfer price. So I can still play around and say this adjustment is not a primary adjustment in the first case because this is not an adjustment to the transfer price. There is no transaction. There is no transfer price. What I am doing is an income attribution, which doesn't fall within the purview of 92C or 92CA for assessments. Then I can still say this is not a primary adjustment in the first case, then I don't have to follow secondary adjustment. Possible. Double taxation 92.2, but now the government has released saying even without 92.2 they will be open to negotiating maps and bilateral APS, so I will skip that part for now. Setting off of balances. So certain countries allow you to set off balances. I have a payable, I have a receivable, I generally knock it off. The Indian FEMA regulations generally don't allow that. But if I have that provision in my country, then can I say the day I have a primary adjustment, I already have a payable balance, I knock it off and I will never be able to pay this. And then I have sufficient time. My 90 days time limit will always give me that cushion when I have a payable balance. It is not a big difference because eventually then I have to bring in that money or maybe I will not pay this money out. But is this
Like
permitted?
you have to just adjust against the future invoice.
Naturally. So there will never be a situation where I have to bring in the money. I will always keep knocking off my own balances. But the Act doesn't allow you to do that. At least here, from a FEMA perspective, you can't do that knockoff, so that would not be possible. What happens when there is a cessation of a relationship? Suo motu adjustment, not possible. APA, MAP, safe harbor, not possible. But in an assessment, my primary adjustment comes 2 years later, 3 years later. What if that entity is not an associated enterprise now? Or what?
Whether the definition of under 92C, when it says associated enterprises, whether with respect to the time when the transaction happens or whether with respect to the time at which the 92C is kicked in.
So, 92B definition says any time during the year. So, for the purpose of disclosure, 92B is very clear that even if it is going to be for a part period of the year, 92C doesn't prescribe any such time. It only says associated enterprise. So, at the time this transaction happened, it is an associated enterprise. No questions there. I have a primary adjustment. My problem will be repatriating the money. Today he is not my associated enterprise. Why will he pay me that money? Or plain instances, if it's a JV entity, tomorrow the JV entity, one of the JV partner exits, it becomes a wholly owned subsidiary. Why will the other JV partner pay me for something that happened, say, 3 years back, when I don't even have a relationship with him? Who is mandated to pay this money then? I am statutorily required to bring the money back. And I will be compliant even if I bring this back from any other entity. For the purpose of 92C, if I bring this money from, say there is an adjustment for excess associated enterprise, I bring it from my parent company also, I am satisfied because I have repatriated this money into India from an associated enterprise. But now he doesn't even have a transaction with me. For me, he's paid a money. How will he justify that particular transaction in his jurisdiction for a transaction that has not even been entered? Second, FEMA regulations. Under what, for what am I receiving this payment? There is no sale of goods, there is no transaction, there is no service. How will I repatriate this money? So, there are others category, but then that will have an, if I say some other nature and try to bring in that money, then I will have an impact on, will I have to account it in that particular nature in which I got the RBI approval? Then I will have a conflict between the accounting aspect of how I have to do for a secondary adjustment to what I have to disclose when I repatriate the money. That is a question that's again remaining unanswered. What if I have multiple AEs, multiple transactions? Smaller entities, 2 companies, 3 companies, fine. I will still be able to do it. There are plethora of companies which have transactions with 50 AEs, 100 AEs. And if I have an assessment, the officer does a very simple job, T&MM, shortfall in margins, adjustment to my transaction. Nobody knows to which AE the transaction is. Today, if my assessing officer is making an adjustment to my purchase transaction, he says adjustment to purchase of components X amount. To which AE? Nobody knows. Should I bring it from one AE? I don't know. Should I divide it proportionately in according to my transaction value to bring it from all my 50 AEs? Maybe yes, but administratively it is not possible. How many debit notes will I raise? How many companies will pay me? How many companies will be ready to pay me? I will never. Deemed international transaction, we already discussed that, it will not be applicable. And what happens to this interest? It says interest shall be offered to taxes. And I always have a situation that the whole intent of bringing in a primary, secondary adjustment is to curb this repatriation of money. So when they say that I have interest and I need to offer it for taxes, is this again subject to secondary adjustment? When I offer it for taxes, do I again say this is receivable from my associated enterprise, reported as an international transaction, again it becomes a primary adjustment, that gets clubbed to my existing advance, does it get compounded again and again? The answer to that is not clear, but there is a small interpretation that can help you, which we already discussed, saying my primary adjustment is on account of transfer price. And the interest that I am imputing here is under 92CE and not as per 92C where the transaction, 92 where the transaction has to be at arm's length. So then this interest is technically not a primary adjustment at all for me to bring in a secondary adjustment and keep compounding it to that extent. But the Act still doesn't clarify whether this should be an out-of-books adjustment. Yes, I offer it for taxes, but am I going to do only out of books? or I'll not bring in the tax impact to my books. It will still continue to exist the way it exists today. That is something which will remain. And today, if I say 90 days has crossed and this becomes an advance and I create an entry, now does that entry become an international transaction? Technically, yes. I create an entry in the books. Any advance is covered under 92B. Then this becomes a international transaction. I have to report it.
The interest also is receivable from an AE. So
Sorry?
again, that the imputed interest is also receivable from an AE. So that again is part of the advance will be one transaction, and the interest will also be an international.
No, I will still say it's a 0% interest advance. See, because the interest, the Act only requires me to offer it for taxes. I don't have to receive this interest from my AE because I am taking a definition that this is not a primary adjustment. Therefore, no secondary adjustment. Therefore, there is no need for repatriation. For the purpose of books, I will say this is 0% advance. No interest is required. Only my interest, my advance will be. But then how do I justify the arm's length nature of that advance? If I say it's a 0% advance, it's not arm's length. Had I invested that money, it would have earned me 6% on FDs. Then how do I certify this at arm's length? Or can I indirectly say, like how we benchmark overdue receivables now and say, my secondary adjustment here is a fallout of my primary adjustment, which has already been tested. Therefore, this is deemed to be at arm's length, and I'm creating this entry only on account of 92C. Should I say other method, say it's at arm's length, and then fight it when it comes? Maybe yes, maybe no. Should I report this in the first case? If not, do I have a 2% penalty under 271 AA for not disclosing this transaction? That is possible. What documentation do I have to maintain? I don't know. Then I have a penalty of 2% under 271G and 271 AA for non-furnishing. So these are questions that still remain unanswered. Well, from a thin capitalization perspective, it's more to do with what is the disclosure. With secondary adjustment, it's more to do with what happens, and nobody has a clue as to how it happens or how it doesn't. So with this, I will just wind up. Before I do, I will probably just give you a quick glance of what are the other countries which have thin capitalization regulations. Many, UK, Finland, Germany, Spain, Argentina, everybody have different thresholds, different methods in which they use the thin capitalization regulations. Australia, Belgium, India is one of the latest entrants to thin capitalization regulations. But on the other hand, secondary adjustments are a handful. You can pick and choose as to how many countries have secondary adjustments. Canada, USA, South Africa, Korea, Spain. These are the major countries that have secondary adjustment, and they have different approaches. Canada has a dividend approach. USA follows both capital contribution and dividend approach. Surprising that US follows a capital contribution, knowing how the tax jurisdiction there works. But South Africa again follows a loan mechanism. Korea follows a dividend mechanism. Canada follows a similar line of US, dividend and capital contribution. So India is not new to either of these concepts. The concepts have already existed, but what it at least seems to do so, unless we receive much more clarification, is that it throws open a lot of questions that still remain unanswered. But for the limited purpose of tax audit, I think we have clarity on what we need to do on secondary adjustments, except for thin capitalization, where what is the amount that I disclose will still remain an issue. Thank you so much. Any questions that I will have to take, I will be happy to do it. Great, and that was my time. Thank you so much, everybody, for patiently listening to me. I hope it didn't get boring enough. Thank you.
Yeah, 1 minute.
Good, sir.
Thank you for the good presentation.